Nouriel Roubini is an economist with a lot of street cred after he anticipated the oil shock and U.S. housing collapse of 2008. His views are often bearish. It's earned him the nickname Dr. Doom. Roubini is chairman of Roubini Global Economics. He was in Toronto at the invitation of the Bomo Book Club. We talked earlier, and I started by asking him for his take on Canada's housing market.
There is frothiness in the housing market here. You look at measures like prices relative to rents, they're about 50% above historical averages, or price of homes relative to per capita income, 60% above historical norm. Mortgage debt has been rising 130% in the last decade. Of course, there are also local markets that matter. Probably the condo market in Toronto has seen excessive amount of construction, is still ongoing. Supply is increasing. In other parts of the country, like the booming region in the west, like Alberta, there is an undersupply of housing. Of course, it depends very much on where you look. But I would say overall, certainly, there is evidence of frothiness. I don't expect a bust like we had in the United States, where you had the subprime bust, because there are many different situations here. Homeowners tend to have more equity in their homes. Interest rates are still low. The banks are better capitalized and been more prudent, but certainly it's a fragile, and there could be a correction down the line. And
when we talk about correction, typically from the top, peak to trough in the housing market, it can get up to 20% without too much trouble. Do you see that kind of price correction in this market?
Probably, unless things go really wrong, 20% is too much. I mean, that's more than a correction. It's something like a bust in home prices and housing that has bigger macroeconomic consequences. I would say if home prices were to correct overall nationally 5 to 10%, that would be a correction, one that doesn't have huge macroeconomic impacts. If you had something closer to 20%, then the risk of a sharp economic slowdown, weakening of consumption, damage of the financial system will be higher. To me, that's more of a tail scenario. One has lower probability than a more moderate correction.
We do have in this country a very high household debt levels. In fact, we went from savings to deficits on a household basis in the last period of years. If you were the government here, and those two things are happening simultaneously, consumers are overstretched, they're taking on more and more debt, and their home values may well move lower, what would be the policy course that you would take to keep that from turning into a crisis for some people?
Well, anything you can do to strengthen economic growth and therefore strengthen job creation and income creation is going to reduce that debt to household income ratio to a lower level. It's a fragile situation, and one of the reasons why growth in Canada could be slow is because consumption growth might be slow with all this household debt. The good news is that, short-term interest rates are still very low, and the Bank of Canada might exit low interest rates very gradually. Long-term interest rates are still very low, and most of the mortgages are fixed rate rather than variable rate. So it's certainly a situation that is difficult, but anything can sustain stronger economic growth. And I would say that while there is fiscal consolidation is necessary, if the economy were to show economic weakness, given the low deficits and the low level of the public debt, there is even room for a fiscal stimulus, one that the country may not need right now, but will be available if things become more fragile.
In fact, our government is very focused, for political reasons, on reaching zero deficit, coming into surplus, and technically maybe there today. Yet our economy is very lackluster, and our unemployment rate remains high. Is there a case to be made that stimulus is needed now, that there doesn't need to be some dramatic event, but that this kind of growth isn't enough to grow jobs?
There is a room for a stimulus if the economy shows a significant slowdown. There is an improvement in growth compared to last year, and next year is going to be in a baseline better. But you're right, the main components of demand are soft because consumption is growing moderately because of the household debt and uncertainties about the labor market. You have the housing now is softening. Fixed investment and capital spending by corporates has remained soft because the economy is growing weakly and there is excess capacity. Exports, especially manufacturing, have been weak because of the strong value of the currency. Of course, there's been a boom in the export of oil and energy, given oil sands, shale gas and oil. That's a positive, but in some sense, that strength of the resource sector keeps the currency too strong and crowds out the traditional manufacturing. So the main components of demand are growing only okay, and exports and fixed investment are particularly weak.
Canada came through the credit crisis well positioned. We took great pride in how stable our banking system was and how quickly we recovered post-recession. I want to ask you to give a letter grade to the government's management of this economy. When you think about all of those factors and consider that we are very dependent on resources, we haven't seen business investment, export rebounding, are we doing a good job here of managing this economy?
Yes, I would say overall yes, it's a pretty good job. You know, fiscal policy is sound and there is room for fiscal stimulus if necessary. Monetary policy has been accommodative given slow growth and moderate inflation. The banking system is sound, even if this hangover of too much mortgage debt is a risk, of course, for the economy and for the financial system, but bigger buffers of liquidity and capital and better supervised financial system. There is this energy kind of boom that if you can find ways of transporting all these new oil and energy to the final markets, and there are constraints and bottlenecks of pipelines and others, is going to be a positive in the long term. Right now there is a softening, of course, of commodities given slowdown of growth in China, in emerging markets, but medium long term strong growth in the global economy is going to imply that the resource orientation of the country is going to be certainly a strength of the country. So overall, it's quite a well-run economy.